Okay, imagine this. You've got these two, like, giant invisible forces constantly playing tug of war with the stock market.
Hmm.
One force, it's solid, right? It'll build on hard numbers, company earnings, economic data, interest rates. It's all logic, analysis, the actual value of stuff.
The bedrock, you could say.
Yeah, the bedrock. And the other force, it's just swirling emotion, fear, greed, excitement, panic. It's the whole messy human side of things.
The collective mood.
Exactly.
Yeah.
So which one really calls the shots? Which one decides where stock prices actually go? Are we trading based on cold, hard facts, or are we all just swept up in a wave of what everyone else is feeling?
It's a fascinating question, isn't it? Because you see it all the time, prices shooting up when the news seems awful or everything looks great fundamentally, but there's this like sense of dread hanging over the market.
Totally. So what's really going on under the surface? That's what we're diving into today, this classic battle. Market sentiment versus market fundamentals. Which one packs the bigger punch for U.S. stocks?
It's a fundamental question, no pun intended, that touches on, well, everything from economic theory to basic human psychology.
Right. And for this deep dive, we've gathered quite a bit of material. We've got academic stuff on investor sentiment, behavioral finance research.
Yeah, and also detailed guides on how analysts actually do fundamental analysis day to day, plus some really practical commentary from investors on navigating those times when, sentiment and fundamentals just seem totally disconnected.
A good mix. So our mission here is to unpack these two concepts, fundamentals and sentiment, see how they interact, how they clash.
And pull out the key nuggets, hopefully, to help you understand their roles and maybe think about how they affect your own investment approach, especially when things feel confusing out there.
Okay, let's start with the basics then. Lay the groundwork.
Sounds good. Let's define our terms first. What are these two forces?
Perfect. So, first up, market fundamentals. What exactly are we talking about here? The logical side.
Right. So fundamental analysis, at its core, is all about figuring out the intrinsic value of something, like a stock or a bond.
Intrinsic value, meaning what it's really worth.
Exactly. Not just its current price tag or what people are hyped about. It's about digging into the underlying business, its health, its prospects, and the broader economic picture it fits into. It's the data-driven, logical approach, asking, based on the facts, what's the actual value here?
Okay, so it's like being a detective for a company's health.
That's a great way to put it. You're gathering all the evidence.
Yeah.
And that evidence falls into a couple of key buckets. First, you've got the deep dive into this specific business.
The company itself.
Yeah. You're crawling through their financial statements, the balance sheet, income statement, cash flow, looking at assets, liabilities, earnings, revenue, debt levels, profit margins, all that good stuff.
The nuts and bolts.
Right. And you're also assessing things like how good is their management? What's the competition like? What markets are they in? And what's the potential there? You really want to understand how the business engine works.
Makes sense. Know the company inside out.
But you can't stop there because no company operates in a bubble, right?
Yeah.
So fundamental analysis also requires looking at the broader economic picture, the macro view.
The economy-wide factors.
Exactly. Things like GDP growth, is the whole economy growing or shrinking? Inflation, what's happening with prices, interest rates super important, the cost of borrowing money affects everyone.
Yeah, big time.
And employment levels, manufacturing output, consumer confidence, all these big picture indicators shape the environment the company operates in. You could have a great company, fundamentally sound, but if the whole economy tanks, well, that's a huge headwind.
Right. So you need both the company view and the sort of landscape view.
Precisely. And the goal of putting all this together, the company data, the economic data, historical and current, is to try and forecast the future. What are this company's earnings likely to look like next year or 5 years from now? What about cash flow?
Okay, forecasting.
And based on those forecasts, you try to arrive at what the security's correct or intrinsic value should be today. What's it worth, considering its future potential, discounted back to the present?
And the core belief here is, even if the market price is totally wacky right now.
The fundamental belief, is that eventually the market price will gravitate towards that true underlying value, like a rubber band snapping back. The market, in the long run, is expected to be rational.
So the profit comes from spotting when the market price is wrong.
Spotting those mispricings, exactly. Finding something undervalued based on your analysis, buying it, and then having the patience to wait for the market to wake up and realize its true worth. Or, conversely, identifying something overvalued.
That sounds like the basis for a lot of classic investing styles.
Oh, absolutely. It's the foundation for buy and hold investing, focusing on owning good businesses long term. And value investing, specifically hunting for those solid companies, the market has unfairly beaten down. It's about finding quality at a good price to hopefully lower your risk.
And what about contrarians? The ones who like to bet against the crowd.
Fundamentals are crucial for them too. Because if everyone's freaking out about a stock or way too excited, the contrarian uses fundamental analysis to say, okay, hold on, let's look at the actual numbers. Does this fear or this hype actually match the reality of the business? They form their own independent view of value.
Right, backing up their going against the grain stance with hard data, not just a gut feeling.
Precisely. And there are different ways to approach this whole analysis. You can go top down.
Top down.
Yeah, start with the big picture. Analyze the economy, what trends are happening, then drill down to industries likely to do well in that environment, and then pick specific, fundamentally strong companies within those industries.
So economy, industry, company, like a funnel.
Exactly. Or you can flip it and go bottom up.
Start with the company first.
Right. Find really promising individual companies based on their own merits. Great management, strong financials, competitive edge, and then consider the broader economic and industry factors. Focus on finding the gems first.
Got it. Forest then tree, or tree then forest.
Yeah.
And what tools do they use? We hear about things like PE ratios all the time.
Yeah, the jargon.
Yeah.
Financial ratios are key. The price to earnings, or PE ratio, is probably the most famous. It just compares the company's stock price to its earnings per share.
Gives you a sense of how expensive it is relative to its current profits.
Kind of, yeah. A high PE might mean investors expect a lot of future growth, or maybe it's just overvalued. A low PE could signal it's cheap, or maybe it's got problems. Context matters hugely.
Okay, so if a stock's at $20 and earns $1 per share, PE is 20.
You got it. And the inverse, earnings to price, EP, some people think of that like an earnings yield. Then there's debt to equity, how much debt versus owner's equity the company uses. A risk measure, return on capital employed, or ROCE, how well they use their money to make money. Very important. And valuation models like discounted cash flow, or DCF.
ECF sounds intense. What's the gist?
It is pretty involved. Basically, you try to estimate all the future cash flows a company's going to generate, like ever. Then you discount those future cash flows back to what they're worth today, using a discount rate that reflects risk and time. Add up all those present values, and that's your estimated intrinsic value.
Wow. So you're trying to value the company based on all its future potential cash.
In theory, yes. It relies heavily on projections and assumptions about the future, though. So it's as much art as science sometimes.
Right. And what about the PEG ratio? I hear that mentioned a lot with growth stocks.
Ah, yes, PEG. Price earnings to growth. It takes the PE ratio and divides it by the expected earnings growth rate.
Why do that?
Well, it tries to put the PE ratio in context. A company might have a really high PE, which looks pricey, but if its earnings are also growing super fast, maybe that PE is justified. The PEG ratio helps you compare companies with different growth rates more fairly.
So a PE of 30 looks high, but if growth is 30%, PEG is 1. Maybe that's reasonable.
Exactly. A PEG around 1 is often seen as a benchmark for fair value, though it's just a rule of thumb. But here's a key point. Things like the PEG ratio rely on estimates of future earnings and growth.
Forecasts again.
Yeah. And those estimates, well, that's where the line between hard fundamental fact and investor sentiment or expectation can start to get a little blurry, you know. Analyst estimates are influenced by outlook, mood, momentum.
Gotcha. Okay, so that's fundamentals, logic, data, intrinsic value. Now, let's flip the coin. Market sentiment, what's that all about?
Market sentiment is, well, it's the overall feeling, the collective attitude, the mood of investors towards the market or a sector, or even just one specific stock.
So not the numbers, but the vibe,
It's like,
psychology.
Exactly. It's the aggregate opinion, the emotion, the expectations floating around. It's not hard financial data itself, but boy, does it impact the market. It tries to capture what people think will happen with future returns.
And why should we care about feelings if fundamentals tell us the true story?
Because sentiment helps explain why stock prices sometimes go completely haywire compared to what the fundamental data suggests. It acknowledges that humans, with all our biases and emotions, are driving these markets, especially in the short term. It helps explain the disconnects.
The human factor messing with the machine. But how do you even measure something like a collective mood? It sounds so fuzzy.
It is challenging, but there are ways analysts try to get a handle on it. One common method is just asking people. Surveys.
Like polls.
Yeah. The American Association of Individual Investors, the AAI, does a famous weekly poll. They ask their members, are you bullish, bearish, or neutral on the market over the next 6 months.
Straightforward enough.
Right. And they publish the percentages. Looking at the trends, especially when bullishness or bearishness gets really extreme, that's used as a sentiment indicator. Other groups survey professional investors too.
So you get a snapshot of optimism versus pessimism.
Exactly. But beyond just asking people, researchers have developed more complex sentiment indexes, often using market data itself. Things believed to be driven more by psychology than fundamentals.
Like what kind of data?
Well, the Baker and Wergler Index is a well-known academic example. They look at things like the pop in price on the first day. An IPO trade's big pops might signal irrational exuberance, right? Or high trading volume, like NYSE turnover. Lots of churning might mean more speculation, less long-term investing. They also look at characteristics of stocks that tend to be more sensitive to sentiment.
What makes a stock sentiment sensitive?
Generally, according to the research, it's stocks that are harder to value fundamentally. Younger companies, more volatile stocks, distressed firms, maybe companies that don't pay dividends, low-profit firms. Where the fundamental story is less clear, sentiment has more room to fill the vacuum and drive the price.
Okay, so where there's ambiguity, feelings rush in.
That's a good way to think about it. These indexes try to capture that overall market mood and see how it affects different types of stocks disproportionately.
So people are actively trying to quantify this mood, this feeling.
Absolutely. And this ties directly into behavioral finance. Sentiment and behavioral finance are deeply linked. Behavioral finance basically provides the why. Why does sentiment have such power? It studies the psychological reasons behind financial decisions.
The biases, the mental shortcuts.
Exactly. How our all-too-human brains can lead us astray when it comes to money. Which brings us to how these two forces, the rational fundamentals and the emotional sentiment, actually play out together in the market, and what happens when they disagree.
Okay, let's get into that dynamic. We touched on the efficient market hypothesis, EMH, the idea that prices reflect all known info perfectly. If that were totally true, fundamentals should just rule, shouldn't they?
That's the theory, yeah. In a perfectly rational world, new fundamental news comes out, the price adjusts instantly and correctly to reflect the change in value. And that's that. No room for messy emotions or sentiment to push things around.
But the real world, not so neat.
Not even close. Look at history. Robert Shiller's work, for instance, showed that big market swings often don't really line up neatly with later changes in fundamentals like dividends or earnings. Think about the dot-com bubble.
Oh, yeah. Crazy valuations.
Exactly. Companies with little or no earnings, sometimes no revenue even, trading at insane prices based purely on hype and hope about the future internet. That's hard to explain with just traditional fundamentals of the time.
Or sudden crashes like Black Monday in '87, a 22% drop in one day. And the sources say there wasn't one clear fundamental trigger for that big a drop that day.
Right. There were background worries, sure, but the sheer scale and speed pointed to something else. Panic, forced to selling, maybe program trading, exacerbating things. It showed that market mechanics and psychology could overwhelm fundamentals, at least dramatically in the short term.
So these big events really punch holes in the idea that only fundamentals matter. Sentiment clearly flexes its muscles sometimes.
It does. And studies show sentiment is often strongly correlated with what the market is doing right now, contemporaneously. High sentiment, market rising. Low sentiment, market falling. It captures the current mood.
Okay, reflects the present. But can it predict the future? Does high sentiment today mean the market will be higher next month or next year?
That's the million-dollar question. And the answer seems to be, sometimes for some things, but not reliably for the broad market's near-term future.
So not a crystal ball for the S&P 500 next quarter?
Generally, no. Research suggests it can have predictive power in specific contexts, maybe for certain commodities, or for predicting the relative performance of those sentiment-sensitive stocks we talked about. Some funds try to use sentiment signals in their strategies. But for predicting overall market direction reliably in the near future, the evidence is much weaker, even unreliable, according to some studies.
Interesting. Sentiment might even make people ignore facts.
Yeah, there's research suggesting investors sometimes underreact to solid fundamental news, like a great earnings report, if it goes against the prevailing negative sentiment. The mood acts like a filter, blocking out information that doesn't fit the narrative.
Wow, so the collective feeling can literally make people ignore reality. That really highlights the behavioral aspect.
Absolutely. And this is where behavioral finance gives us the tools to understand why sentiment has this power. It points to specific cognitive biases.
Mental shortcuts that lead us wrong.
Exactly. We use heuristics, rules of thumb all the time. They're efficient, but can cause errors. like the representativeness heuristic, buying a stock just because it seems like the next Amazon without checking if it actually is fundamentally similar.
Or availability heuristic, being overly influenced by recent vivid events, like fearing a crash because you vividly remember 2008.
Precisely. And that ties into frame dependence. How information is presented or filtered through our past experiences changes how we react.
Like the 2008 trauma coloring reactions to minor dips today.
A perfect example. The source mentioned how that fear lingered, making people associate any downturn with potential collapse, even when fundamentals were totally different. The memory frames the present situation negatively.
That makes sense. What about overconfidence? That must fuel bubbles.
Oh, big time. People naturally overestimate their own abilities. In investing, after a few wins, they might think they've cracked a code, start trading more aggressively, overweighting their own gut feelings, and ignoring contradictory data.
And does that work out well for them?
Usually the opposite. Studies show frequent traders, often driven by overconfidence, tend to underperform the market significantly after costs. More trading doesn't mean smarter trading.
Right. And then there's the herd instinct, groupthink.
Classic behavioral bias. We have a strong tendency to follow the crowd. FOMO, fear of missing out when everyone else seems to be making money. Or panic selling because everyone else is panicking. It feels safer to be wrong with the group than right all alone sometimes.
Even if the group is heading for a cliff.
Exactly. The sources used a good analogy. The market's like roulette, usually probabilities known. But in high sentiment times, it's like poker. You have to watch the other player's psychology.
And this leads to noise trader risk. What's that?
Noise traders are people trading on noise sentiment, rumors, fads, not fundamentals. When enough of them act together, driven by sentiment, they can push prices way off fundamental value.
And that's risky for the rational folks. Why?
Because the price can stay wrong longer than you can stay solvent. If you bet against the hype based on fundamentals, the noise traders might keep pushing the price up purely on sentiment. You could run out of money or get forced out before the price eventually corrects. So being right fundamentally doesn't protect you from short-term sentiment-driven pain.
Wow. So even knowing the true value isn't enough if the crowd stays irrational for too long. That really explains the disconnect we sometimes see.
Exactly. When feelings and facts just don't line up. And the source gave that great example from early 2019.
Right. Fundamentals looked pretty good then, didn't they?
Yeah, the U.S. economy was solid. GDP growth was decent, over 2%. The job market was really strong. Lots of hiring, wages rising, people even coming back into the workforce.
Good signs. And company profits.
Also strong. S&P 500 earnings growth was estimated in the double digits, like 10.8%. Businesses were doing well. Fundamentally, things looked healthy.
So logically, investors should have been pretty cheerful.
You'd think. But the sentiment was actually quite negative. After a dip in late 2018, there was this widespread feeling the market was in a tailspin. Lots of anxiety, fear of recession.
And the ghost of 2008 was playing a role.
Absolutely. That memory was framing the situation, making people overly fearful, associating any wobble with a potential crash, even though the current fundamentals didn't support that level of panic.
So the facts said one thing, the feelings said another, a total disconnect.
A classic disconnect. And the source made a crucial point. The biggest danger then wasn't the economy itself, but the fear. The risk that negative sentiment could become a self-fulfilling prophecy.
Meaning, enough scared investors sell based on fear, not facts. And that selling pressure actually causes the downturn they were afraid of.
Exactly. Sentiment creating its own negative reality, even if the fundamentals were initially okay. It shows the raw power of collective psychology.
And it's important to remember, as the source pointed out, most recessions aren't like 2008. That was unusually severe.
A very important perspective. And interestingly, in that 2019 example, even while sentiment stayed negative in surveys, the market itself had actually already started rallying significantly off its lows. The mood lagged the market's recovery.
So the feeling didn't even match the current market action, let alone the fundamentals. This disconnect must be incredibly challenging for investors. How do you navigate that?
Right, that brings us to strategies.
Yeah.
What do you actually do when sentiment and fundamentals are telling you completely different stories?
Yeah, what's the game plan? The sources had some clear advice.
The main message, really loud and clear, was, don't let sentiment drive the bus, especially when it's contradicting the facts. Keep your focus on the underlying reality, the economy, the companies.
Stick to the fundamentals, even if the market mood is terrible.
Pretty much. Resist that urge to panic. Sell good investments just because prices are dropping due to fear. Selling into that fear often means locking in losses and missing the eventual rebound when fundamentals reassert themselves. If the underlying businesses are solid, short-term sentiment swings aren't necessarily a reason to bail.
Trust the numbers, not the noise.
That's the idea. Another strategy mentioned was to look for bright spots during that kind of volatility. When sentiment makes the whole market choppy, some sectors might hold up better.
Ah, the defensive stuff.
Exactly. Like in that 2019 example, sectors like utilities, healthcare, consumer staples, things people need regardless of the economy, tended to outperform the more cyclical sectors like airlines or retail, which are much more sensitive to economic mood swings.
Makes sense. People still need power and food, whether they feel optimistic or not, so focusing on defensive areas could be one tactic.
Right, and this also has implications for active versus passive investing.
How so?
Well, passive index funds just track the market, right? Great and smooth bull run. But if sentiment causes the whole market to plunge irrationally, your index fund goes down with it, no questions asked.
You're just riding the sentiment wave up or down.
Correct. An actively managed fund, in theory, could navigate that better. A manager focused on fundamentals might underweight the areas getting hit hardest by sentiment, overweight undervalued stocks, or shift towards those defensive bright spots.
They can try to steer around the sentiment storms.
They can try, but, and it's a big but, active management costs more in fees, and there's absolutely no guarantee the manager will actually succeed in outperforming or navigating better. Many don't. So it's a trade-off. Potential flexibility versus higher costs and uncertainty.
Got it. Potential benefit, but definitely not a sure thing. What about just doing the opposite of the crowd? Contrarian thinking.
Ah, yes. The sources definitely touched on that. Since nobody really knows market timing perfectly, trying to sell at the peak of euphoria or buy at the depth of despair based purely on sentiment is incredibly hard, probably impossible consistently.
Don't try to time the mood swings.
Right. So the contrarian focuses on fundamentals. When the crowd is panicking and selling off fundamentally sound companies at prices that seem way too low based on the numbers.
That's the contrarian's opportunity.
That's the idea. They see the crowd's fear creating a potential bargain based on intrinsic value. And interestingly, the sources suggested that extreme sentiment readings can sometimes be a contrarian indicator for longer-term moves.
Using sentiment against itself, almost. How does that work?
Well, the thinking is if sentiment gets extremely bullish-like, almost everyone is wildly optimistic according to surveys. Maybe all the good news is priced in, everyone who's going to buy has bought, and the market is vulnerable to any disappointment. It could signal the potential top or downturn ahead, maybe over the next year or so.
Too much optimism sets the stage for a fall.
Potentially. And conversely, if sentiment gets extremely bearish, everyone is terrified, convinced the world is ending, maybe all the bad news is priced in, everyone who's going to sell has sold, and the market is poised for a rally on any glimmer of hope. Extreme pessimism might signal a bottom is near.
So extreme feelings might indicate the turning point is closer.
That's the contrarian interpretation. It's not about day-to-day timing, but using those extreme emotional peaks and valleys as potential clues for a longer-term reversal. It takes guts to bet against the overwhelming mood, though.
Definitely requires conviction. Okay, so we've got fundamentals, the data, the value, and sentiment, the mood, the psychology. We've seen how they interact, how they diverge. So the big question, which one drives the market more? What's the final verdict from the sources?
Well, like most complex questions, there's no simple, it's always this one answer. It's clear both forces are constantly at play.
A perpetual dance.
Exactly. In the short term, sentiment often seems to have the upper hand, fueled by news, biases, herding. It can really push prices far from fundamental value. That's where you get the volatility, the bubbles, the crashes, the mispricings. Emotion can definitely hijack the short-term price action.
So sentiment causes the waves, the noise.
You could say that, but, and this came through strongly in the sources, especially from a longer-term perspective, fundamentals are like the underlying tide, the gravity. While sentiment creates those temporary distortions, the market, over the long haul, tends to reward actual value creation, profits, growth, solid balance sheets.
Right.
The price eventually tends to gravitate back towards that intrinsic value based on the economic reality.
So sentiment rules the day-to-day chaos, but fundamentals dictate the long-term destination.
That seems to be the most consistent message. Sentiment can throw the market's compass way off course temporarily, creating both risks and opportunities. But the true north, over time, seems to be tied to the underlying numbers, the actual economic substance.
That makes sense. The short-term market can feel like a voting machine driven by popularity and mood, but the long-term market acts more like a weighing machine, assessing true substance.
That's a classic analogy, and it fits well here. And that example of investor confidence collapsing despite solid fundamentals really underscores sentiment's immediate power to cause harm. But the ultimate advice remains. Focusing on the fundamental reality is likely the more reliable path for long-term investing success.
Okay, this has been a fantastic deep dive. We've really unpacked the tension between market fundamentals, that logical, data-driven view of value and market sentiment, the collective emotions, biases, and expectations swirling around.
Yeah, we saw how fundamentals give us a framework for worth, while sentiment helps explain those sometimes wild, psychology-driven market moves, especially short-term. We talked about the disconnects when feelings and facts clash, and importantly, we covered strategies for navigating that, focusing on value, maybe looking at defensive plays, the active versus passive consideration, and even using sentiment as a contrarian tool.
And the key takeaway seems pretty clear. Sentiment can absolutely rock the boat in the short term, cause major volatility, make things feel unpredictable, even irrational.
But it's the underlying fundamentals, the actual economic and business health, that ultimately act as the anchor, determining value over the long run. The market might lose its way emotionally for a while, but it tends to find its way back to the reality of the numbers eventually.
Which leaves us with a final thought for you to chew on. If fundamentals tend to dictate the long game, but sentiment can cause so much short-term disruption and opportunity, how do you find the right balance? How do you pay attention to the crucial fundamental data while still acknowledging and maybe even navigating the powerful, sometimes illogical force of human emotion in the market? Is ignoring sentiment altogether the answer? Or is understanding it the key to avoiding the herd's mistakes and perhaps even capitalizing on them?
Something definitely worth considering on your own investment path. That interplay between logic and psychology is what keeps things interesting, that's for sure.
Absolutely. We hope this deep dive gave you some valuable perspective on these two powerful market forces. Thanks for joining us.
We'll see you next time.